What if I told you that right now on Wall Street, the most sophisticated billion-dollar artificial intelligence systems are being, well, consistently beaten by a strategy you could literally execute in your sleep?
Right, yeah.
I mean, a simple, boring buy-and-hold index fund strategy is currently outperforming the most expensive algorithms on the planet when it comes to long-term market timing.
It is honestly one of the most fascinating contradictions in finance today. I mean, we are seeing just unprecedented amounts of capital flowing into this technology.
Oh, absolutely.
Yet the holy grail of trading, knowing exactly when to enter and exit the market over years, is still somehow eluding the machines.
Welcome to our deep dive into the source material. Today, we are on a very specific mission for you. We're taking a stack of recent market reports, academic studies, and industry data to really cut straight through this massive cloud of hype surrounding AI and finance.
Yeah, because there is a lot of hype right now.
So much. We want to understand how this technology is actually rewiring investment banks, hedge funds, and wealth management from the inside out. But most importantly, we want to figure out what this structural shift means for you, the everyday investor.
Right, because the ripple effects are huge.
Exactly.
Yeah.
I mean, paint a picture of Wall Street in 2026 for a second. If you still have that 1980s cinematic image of brokers screaming orders over phones, throwing paper tickets around, erase that.
Yeah, those days are long gone.
Completely gone. Today's reality is just these silent trading floors, totally driven by algorithms processing like terabytes of data in milliseconds.
And even if the AI isn't perfect at timing the market over the span of years, the numbers we are seeing in the short term are frankly mind-bending.
They really are mind-bending. I mean, if you look at the first half of 2026, this massive AI boom just drove the S&P 500 to its best quarter in 6 years.
6 years? That's wild.
Yeah, and the engine behind that wasn't just general economic health, right? It was heavily concentrated,
Right.
led by NVIDIA, Alphabet, and the broader semiconductor sector. Sure, but the story isn't just about stock prices going up on the outside. It's what's happening on the inside of these financial institutions.
Yeah.
The internal spending is just insane.
Oh, the capital allocation is unprecedented.
Like, we're looking at reports showing that hedge funds are literally paying up to $25,000 a day for top-tier AI experts.
A day.
A day. That is well over $700,000 a month for one single person.
When you see salaries like that, or, market movements of that magnitude, the natural human instinct is to write it off as a fad. Like, oh, it's just another bubble.
Right, like crypto in 2021 or something.
Exactly. But the data we are reviewing suggests something much deeper. I mean, this isn't just a technological upgrade. We're not just moving from, one version of a spreadsheet to a slightly better version.
Right.
This is a structural revolution. It really is comparable in scale to the massive computerization of the financial markets we saw in the 80s and 90s.
Oh, when we went from physical paper to electronic trading.
Exactly. Except this transition is happening exponentially faster. And while it might seem like pure magic from the outside, we really have to unpack the mechanics of it. We need to look at why it works, where it completely fails, and the very real risks it introduces.
Like systemic volatility.
Right.
And algorithmic hallucinations.
Precisely. Because if everyone is using the same magic trick, it becomes very dangerous.
Okay, let's unpack this.
Sure.
Because going from the overarching hype to the concrete financial realities of, who is actually spending money and how much is really eye-opening.
It's staggering.
The research indicates that hyperscalers, those massive tech companies that actually provide the cloud computing infrastructure, they're projected to spend an unbelievable $760 billion on AI in 2026 alone.
And, well, keep in mind that $760 billion is just the foundation.
Right.
That is just the infrastructure required to power what the actual financial institutions are trying to do on top of it. If you look at the massive corporate rollouts, they are staggering.
Like JP Morgan, right?
Yes. JP Morgan has deployed enterprise-grade generative AI tools to over 200,000 employees.
200,000 people. That is practically a small city of bankers, all just armed with this technology.
It really is. And Morgan Stanley and Citi are doing the exact same thing. They are using these tools to save literally hundreds of thousands of hours in coding and analysis.
Wow.
But then, you move over to the hedge funds and the game changes entirely. Firms like Balyasny, Man Group, Jane Street, They aren't just buying off-the-shelf AI software.
No.
No, they are physically deploying tens of thousands of their own GPUs, graphics processing units, specifically to build proprietary systems for high-frequency trading, anomaly detection, and research.
I hear these numbers right. Like
Mm.
$760 billion in infrastructure, tens of thousands of GPUs being hoarded by hedge funds, 250,000 bank employees using this tech daily. I really have to push back a little bit here.
Sure, go ahead.
Is this actually translating to better returns?
Mhm.
Or is Wall Street just throwing billions of dollars at the latest shiny toy because everyone else is doing it? It honestly feels like an arms race where no one is entirely sure if the weapons even work.
It's a very valid skepticism, actually, and it is exactly why we need to rely on the academic evidence here rather than just taking corporate press releases at face value.
Right, because they all want to sound cutting edge.
Exactly. The short answer is yes, the technology absolutely works. But it works in highly specific, mathematically rigorous ways. Studies published in PMC and Science Direct recently ran the numbers on this,
Good.
and they confirmed that machine learning and neural networks are genuinely improving price forecasts and risk management. Specifically, they point to something called VRNNs.
Wait, let's pause there because I want to understand the mechanism. The sources mention these VRNNs, variational recurrent neural networks. For those of us who, aren't quantitative data scientists, what does that actually mean?
It's a bit of a mouthful, I know.
Yeah. How is a VRNN different from the computer models Wall Street has been using for the last 20 years?
That's a great question. Think of traditional quantitative models like a train on a track. They use linear regression. They look at historical data in a straight line to predict where the train is going to end up.
Okay, so if X happens, then Y will probably happen.
Right. It's rigid.
Yeah.
A VRNM, on the other hand, models markets more like a complex weather system. The recurrent part of the name means it doesn't just look forward. It constantly loops back on itself.
Oh, interesting.
It takes its own past errors, feeds them back into its current calculations, and continuously adjusts. It is designed to handle highly dynamic, nonlinear variables that are constantly shifting.
And so the academic data actually shows this is working.
Yes. When you apply these VRNNs to Wheatley price predictions, they're significantly outperforming traditional linear strategies when you look at their Sharpe ratios.
And the Sharpe ratio, just remind me, what exactly does that measure in this context?
Oh, sure. It is a measurement of risk-adjusted return. Essentially, it tells you if the returns you are getting are actually worth the risk you took to get them.
Got it.
A higher Sharpe ratio means you are either getting more return for the same amount of risk, or the same return, but taking on significantly less risk to achieve it.
Okay, that makes perfect sense. So the math is solid. The AI is actually finding alpha, that elusive market edge, at least in these short-term, weekly predictive windows.
Exactly. It's objectively beating the old models there.
Which naturally leads us to ask, if it's so good at this short-term math, what is the AI actually doing day to day inside these firms? Because from what I'm reading in the sources, it is not just executing trades, it is handling a massive amount of the grunt work.
Oh, absolutely. The heavy lifting of financial analysis.
Right.
That is where the immediate, undeniable cost savings are happening. It's doing the things human analysts, frankly, hate doing. Fraud detection, automating endless compliance workflows, and most importantly, document analysis.
The document analysis part is fascinating to me. The research highlights that they are using AI to instantly parse 10K reports. Now, a 10K is an annual financial report that publicly traded companies have to file with the SEC, and they are notoriously brutal to read.
Oh, they can be hundreds of pages long, just dense text.
Right. Hundreds of pages of financial jargon, endless footnotes, obscure risk disclosures. What is the AI actually doing when it reads a 10K that makes this so revolutionary?
Well, it's looking for the needle in the haystack that a human eye just naturally glosses over. Let's say a tired human analyst is reading a 10K on a Friday afternoon.
They're ready to go home.
Exactly. They might skim over footnote number 42 on page 118, which mentions a slight change in how the company is categorizing a specific type of debt.
Sure.
The AI doesn't get tired. It reads that footnote, cross-references it instantly with the last 10 years of that company's filings, recognizes a pattern of hidden liabilities, and flags it as a major risk factor in milliseconds.
Wow.
It is just an unbelievable efficiency multiplier.
It's basically like having a tireless super assistant who will happily read dozens of these massive documents while you sit back and sip your coffee.
Pretty much.
But there is a massive catch. This super assistant sometimes just completely fabricates information. much like your uncle at a family gathering.
Right, the hallucination problem. What's fascinating here is how a machine built on strict mathematics actually makes things up.
Yeah, how does that even happen?
To understand why it hallucinates, you really have to understand what a large language model, an LLM, actually is. It is not a database of facts. It is, at its core, an incredibly advanced autocomplete.
Like on your phone, but on steroids.
Exactly. When it generates a summary of that 10K, it isn't thinking about the absolute truth. It is calculating the most mathematically likely next word in a sequence, based entirely on its training data.
So if the math suggests that a certain fictional ticker symbol or a completely fake revenue number fits the linguistic pattern of a successful earnings report, it'll just insert it.
Yes, and it will do it with absolute, unwavering confidence. Because mathematically, the sentence makes perfect structural sense, even if it's factually completely wrong.
That is terrifying. You have to double-check everything it produces.
You really do.
And, that structural limitation explains a lot about the next major finding in our sources. We mentioned at the very beginning that the smartest AI is losing to a basic buy-and-hold strategy when it comes to long-term market timing.
Yes, the WSJ and ArcSev study.
Right. Researchers tested these large language models to see if they could time the market over the long haul, and they completely failed. Why? I mean, if they have all the historical data, why can't they predict the long-term trend?
It really comes down to how these specific models process market sentiment and risk based on their training data. Think about what they're trained on, financial news, historical market movements, earnings transcripts.
And financial media loves hyperbole.
Exactly. And historical data is heavily indexed with massive anomalous events like market crashes. The study revealed that because of this, the algorithms act far too conservatively during a bull market.
Walk me through that. What is the AI seeing during a bull market that makes it act so conservatively?
Well, when the market is rallying and hitting all-time highs, the AI looks at the rising valuations, compares them to historical data, and essentially gets nervous.
It gets stage fright.
Kind of. It sees conditions that have, in the past, occasionally preceded a crash. So it flags the environment as statistically too risky and starts pulling money out right when it should be riding the momentum of a multi-year bull run.
It gets scared by its own shadow.
Yes. And conversely, during a bear market, when prices are crashing across the board, the AI looks at the historical averages, sees what it calculates to be incredible mathematical bargains, and acts way too aggressively.
So it just starts buying up assets while they're still plummeting, basically catching falling knives.
Because it lacks the context to understand why the prices are falling, it just sees a cheap number. It doesn't realize that maybe the price is cheap because the entire macroeconomic paradigm has shifted or, a technology is totally obsolete.
It completely lacks human intuition.
Precisely. And that brings us to an enormous aha moment, probably the single most important takeaway from all the sources we reviewed.
Okay.
Researchers at the SMU Cox School of Business ran a massive study on this dynamic, and they proved that funds which deliberately integrate machine learning with human judgment consistently definitively outperform purely algorithmic funds.
The cyborg approach.
Right. In the industry, they often call it the centaur model, half human, half machine. The data is telling us that the future of finance is inherently collaborative.
That makes a lot of sense.
The AI is unparalleled at processing millions of data points, finding those nonlinear patterns, flagging anomalies. But you absolutely need the human portfolio manager sitting at the desk to provide the macroeconomic context.
You need a human to sense, irrational exuberance.
Exactly. To understand the nuance of a geopolitical crisis and to ultimately make the final call, the technology is designed to amplify human intuition rather than replacing it.
That is a huge paradigm shift for anyone listening. The AI isn't some infallible oracle in a glass box printing money. It's an incredibly powerful, slightly flawed tool that requires a human hand firmly on the steering wheel.
Very well put.
But, having established that this centaur model, AI plus human intuition, is the ultimate winning formula, we really have to look at the macroeconomic consequences of that. Because what happens when literally every major institution on Wall Street adopts that exact same winning formula?
Right. That is where we transition from incredible technological potential to very real systemic risk. And the research is raising some massive red flags on this front.
Yeah, because if every major bank is using the same super assistant, it stands to reason they might all start making the exact same moves at the exact same time. There's a study from NYU in our sources that warns about this specifically. They call it the herding effect.
Yes, the herding effect.
Mechanically, how does this herding actually happen?
It's a very logical progression, actually. If Morgan Stanley, JP Morgan, and Jane Street are all training their proprietary AI models on the exact same historical data sets, the same SEC filings, the same market histories.
Because there's only so much financial data out there.
Exactly. And they are using similar neural network architectures to optimize for risk. Those models are inevitably going to start arriving at the exact same mathematical conclusions.
Meaning their portfolios become completely homogenized, they all start buying the exact same things.
Yes, and a healthy, functional market requires diverse opinions. You absolutely need a buyer and a seller to disagree on the fundamental value of an asset to create liquidity.
Right. If everyone wants to sell and no one wants to buy, you have a problem.
Let's look at a hypothetical example. Say an obscure supply chain company reports an earnings miss. A human trader might stagger their sell-off or wait a day to see how the market reacts. But if three different billion-dollar algorithms at three different funds all read that same report simultaneously, apply the same risk model, and instantly decide to sell.
You don't just get a normal dip in price, you get a massive amplification.
Exactly. They all hit the exit door at the exact same millisecond. The speed of the AI turns what should be a routine sell-off into a complete liquidity vacuum, which can easily trigger a flash crash.
It is the ultimate crowded trade. And speaking of crowding, we have to talk about the physical hardware driving all of this. Because the unprecedented concentration of money flowing into a single technology naturally reminds a lot of seasoned investors of the dot-com bubble in the late 90s.
Well, parallels are definitely there.
The sources note that prominent investors, like Michael Burry, are openly sounding the alarm on this.
And their concern is very well founded. When you have a projected $760 billion being spent, you would naturally assume that money is spread across a massive ecosystem.
Right.
But it isn't. A huge percentage of that capital is flowing into just a handful of providers. NVIDIA is the most obvious example.
NVIDIA has just been on an absolute tear.
Right. The entire financial system is becoming heavily, precariously reliant on a remarkably narrow supply chain for the specific chips that make this whole revolution possible.
So if there's like a manufacturing bottleneck or a geopolitical conflict that disrupts semiconductor shipping, the ripple effects wouldn't just hit the tech sector, they would directly impact the operational capacity of Wall Street.
Correct. It is a massive concentration of physical risk.
But, the physical hardware is just one part of the danger. The software itself introduces a problem that I find even more concerning. It's the black box problem.
Yes, the transparency issue.
Let's say I'm an investor and a fund using one of these advanced VRNNs loses $10 million of my money in a fraction of a second. I'm obviously going to demand to know exactly why the AI made that specific trade.
And the terrifying reality is that in many cases, the fund manager wouldn't be able to tell you.
Wait, really? They wouldn't know?
Often, no. With deep learning neural networks, the math is so incredibly complex and the data layers are so deep that the human operators often cannot reverse engineer the exact pathway the AI took to reach a specific decision.
Which creates a total regulatory nightmare. How on earth do you regulate a financial system when the people running it don't fully understand how it's making its decisions?
You've hit on the exact transparency crisis that is keeping regulators awake at night right now. It completely fractures the concept of accountability.
Yeah, who do you sue?
Exactly. If an algorithm independently triggers a flash crash that wipes out billions in value, who is legally at fault? Is it the developer who wrote the base code, the portfolio manager who deployed it, the cloud provider hosting the servers?
It's a mess. And this black box problem extends beyond just high-frequency trading, too. The sources highlight some serious mechanical issues when AI is applied to everyday consumer finance, specifically around how these models process historical data.
Oh, this is a huge issue.
Yeah, reports from the CFA Institute and the European Central Bank illustrate a major flaw in how AI handles lending and credit scoring.
It really is the classic garbage in, garbage out dilemma, but at an institutional scale.
Right.
If a bank trains a new AI model on 50 years of historical mortgage approval data, the AI isn't analyzing the morality of that data. It is just looking for mathematical patterns of who paid back loans and who didn't, based entirely on the metrics it's given.
If that historical data contains decades of human bias, like systematically denying loans to specific zip codes or demographics, the AI doesn't know that was a flawed or biased human decision.
Exactly. It just sees a statistical correlation that it believes represents good risk management. So it adopts that pattern and automatically applies it to new loan applications.
Wow.
It mechanically replicates and scales historical discrimination, but it hides it behind a wall of impenetrable, seemingly objective mathematics. The bank denies the loan, but when asked why, they just point to the black box.
That is a massive operational and legal liability for these institutions. Regulators must be scrambling to figure out how to police this.
They are trying, but they are miles behind the technology. We are seeing some frameworks start to take shape, like the EU AI Act and various new guidelines in the US trying to mandate some level of algorithmic transparency.
Right?
But as the sources clearly point out, there is a severe lack of global coordination. Capital moves instantly across borders. If the EU heavily regulates how an AI trading model can operate, but another jurisdiction with looser laws doesn't, you just end up with a fragmented, highly vulnerable global system trying to police a technology that has no borders.
So what does this all mean? We have covered a massive amount of ground today, from $760 billion infrastructure spends and dynamic neural networks to hallucinating super assistants and the very real threats of flash crashes and algorithmic herding.
It's a lot to take in.
It is. What does this mean for you, the regular investor? Whether you're managing your own retirement account or just trying to understand where the global economy is heading. Based on everything we've unpacked from these sources, the primary takeaway is that the velocity of the market is going to aggressively increase.
Absolutely.
Markets are going to move faster, and reactions will be sharper. There are clearly huge opportunities, particularly in the tech and semiconductor sectors, that are building the physical infrastructure for this shift. But the margin for error is shrinking rapidly. You are now participating in an ecosystem driven by machines that process terabytes of data in the blink of an eye.
You really can't just blindly follow market trends anymore.
No, because the trend might just be a herd of identical algorithms temporarily acting on the exact same piece of news. It requires deep financial education, strict verification of your sources, and aggressive diversification to insulate yourself from potential AI-driven flash crashes.
I think that is the perfect synthesis. If we connect this to the bigger picture, the lesson here is absolutely not to run away from the technology.
Right. You can't hide from it.
Exactly. It is to understand it for what it truly is. The power comes from dominating the tool rather than being intimidated by it. AI is a brilliant, tireless system that excels at identifying short-term mathematical patterns at a scale human brains simply cannot comprehend.
It lacks wisdom.
Exactly. It completely lacks wisdom. It cannot understand the nuance of a sudden, unprecedented global event or a subtle, unquantifiable shift in consumer behavior that doesn't show up in a financial filing until it's far too late. For anyone navigating this new landscape, you have to maintain a profound, healthy skepticism, just as you always should in finance.
It really is the ultimate paradox of this entire AI revolution on Wall Street. The more these massive institutions spend on silicon, servers, and proprietary models to try and gain a unique edge, the more they mathematically homogenize the market.
It's ironic.
It is. So I'll leave you with a final thought to mull over. If the future of finance is truly human intuition amplified by artificial intelligence, and eventually every single major player on the street has the exact same AI super assistant running on the exact same chips, processing the exact same data sets, does human intuition actually become the most valuable, scarce asset left on Wall Street? If the algorithms all perfectly cancel each other out, perhaps the ultimate market edge is simply being human.